and thanks to Alex and London Blockchain Labs for inviting me. Today we're going to talk about many topics on the overall theme of let's disrupt everything with blockchain. So we have an opportunity to discuss about the latest happenings in the cryptocurrencies and blockchain world, securities regulation, what are the latest protocols and some advanced technologies and advanced trends we can expect this year, and who are the most watched inventors, and what are some exciting things that we can look forward to, for example, like stable coins and decentralized exchanges and so on. And also, one of the biggest industries that is yet to be touched by blockchain and smart contracts, which is capital markets, which is my domain. So we're going to talk about a lot of subjects. So if you have some questions, I request you to hold on till the end, even if you're getting bored. And you may stop me at whatever time, 7:30?
Sorry?
7:30 is when you
7:30, yeah. Well, yeah.
So you can stop me at 7:30 and we'll open it up to questions, right? Okay, to start with, I want to ask you a few basic things. So, what do you think of when you hear the word blockchain?
Bitcoin.
Okay.
Decentralized.
Okay. Sorry? Ledger. Okay.
Trust.
Okay.
Power to the individual.
Sorry?
Power to individual.
Wow. Okay.
Cryptographic hash function.
Okay.
Consensus system.
Okay, great.
Distribution system.
Anything more?
Smart contracts.
Okay. Sorry?
Open source. Open source.
Okay.
Disruption.
Fantastic. Fantastic. I think you've covered my entire talk. Congratulations. So that also speaks to the academic institution we are in. You're all right. So when we think of technological advancements or any new technologies to hit mainstream, we have to measure them on a few metrics, right? So disruption is one of them. But disruption is an after effect of something else. So something that we haven't yet termed or coined, which has gone into mainstream, is called social scalability, right? So any technological advancement that was a massive success has had this social scalability in a huge manner. So if you've been watching the headlines, the latest headlines are to do with Facebook. Facebook was a tremendous success because not only it was the social media platform, it took social scalability to a different magnitude, which we had not seen before, right? So internet was similar in its gigantic appeal as well as mass pervasiveness. And that social scalability achieved a few features for the internet. So for the first time, we were able to discover prices on the internet. So price discovery was the basic premise that unleashed internet into one of the massively adopted technologies, right? So and then came, so after price discovery came matchmaking, right? So price discovery, just seeing prices or just discovering, the various suppliers was not enough. It also took the social connectivity beyond the Dunbar number, which was a natural limit placed on the number of connections we could have. So immediately you could matchmake between strangers that don't know each other and between strangers that cross geographical borders and so on. So instantly that was a social scalability that was phenomenally improved upon whatever existed before. So what is Bitcoin? So Bitcoin has a lot of definitions, right? And there's a lot of rich history of 40-50 years before Bitcoin. Bitcoin wasn't a phenomena that emerged on the mainstream consciousness in 2008. There were at least 40-50 years worth of developments that preceded the massive hysteria that is Bitcoin today. So, so if you think of Bitcoin or blockchain, the main social scalability feature if you want to compare it to internet social scalability, which was price discovery and matchmaking, is trust minimization, right? So at the core of everything we do with blockchain is trust minimization. And I say this and I want to make one particular distinction here. So let's say we are all in the room and I ask you, tell me something that is awesome, right? So somebody might say my girlfriend, somebody might say my vacation and so on. And then if you ask Steve Jobs, what is awesome? You know, his definition is something else. Or if you ask Stephen Hawking, what is awesome? His definition is something else, right? Like he might come up with some neutrons emitting something from black holes, and Steve Jobs would be, you know, a new design of his Apple product and so on. So the degree of awesomeness has a large variation between us and between Steve Jobs. So similarly, if you ask about the impact of blockchain or what is the characteristic feature of decentralization, and if you ask the whole world and if you ask Satoshi Nakamoto, they are vastly different concepts. So I'm going to give you a slice of view from Satoshi Nakamoto's point of view of what is decentralization and what is blockchain. Okay, so let's start with a disruptive capital markets platform. Okay, here you go. So today, all cryptocurrencies, I don't know if it is fallen from the $800 billion market cap, but this was the market cap in not too long ago. And if you compare it with Bill Gates' net worth, which is $87 billion, and just a year ago, last January 2017, the cryptocurrencies, the whole market cap of cryptocurrencies was just $20 billion. And if you look at the stock market, which is all securities of all companies, all industries across the world put together, it is something like $85 to $87 trillion. And look at Bitcoin, just Bitcoin alone was like $40 billion, which is comparable to net worth of, say, Michael Bloomberg, who is probably the 10th richest man on earth. And Bitcoin today, roughly maybe $300, $400, considering the recent price crash. And gold market cap, $8.2 trillion. And all money, this is all money in circulation, including US dollars and Swedish krona, all sorts of currencies, Indian rupees and so on, which is again close to the entire stock markets, which is around $80 trillion. So for those who have really understood the impact of Bitcoin, right? Bitcoin, which is currently around $500 billion, what is Bitcoin a rival to? Well, that has become an extremely complicated question to answer now, even though it was simple a few days ago, because in US, so the Securities Exchange Commission has said Bitcoin is a security, and CFTC, which is Commodities and Futures Trading Commission, has said Bitcoin is a commodity, and FinCEN has said it is money, and then IRS has said it is property. And all the other countries, like Switzerland recently has said cryptocurrencies are payment token, utility token, security token, 3 distinctions. And some countries like Japan and so on, depending on their preferences, have stated it to be security, commodity, and so on, right? So this question was not a trick question, but suddenly it has become a trick question because of so many definitions which people have given it. So if Bitcoin were thought to be a rival to fiat currency, which is US dollars, right? US dollar circulation is around $5 trillion. So Bitcoin is 500 billion. And of course you have lots of altcoins and cryptocurrencies and so on. So if you compare Bitcoin to the fiat currencies, and forget about Bitcoin for a moment, and look at blockchain as the underlying technology that can touch various industries, and then look at this big behemoth, all-comprehending industry here, sorry, a very comprehensive industry, which I mean to be all-inclusive, not all-comprehending, which is around $70–80 trillion, and we haven't even begun to build applications which touch upon those kind of industries. So that is the future that that lies in waiting for us, for especially the lucky entrepreneurs who have been privileged to get onto this industry early enough. Okay, so I come from Wall Street, so I'm an investment banker by background. So this is my natural playground. So if you look at all these investment banks, one characterizing thing of investment banking is it's phenomenal in the sense that industry started as a middleman industry, as an intermediary industry, not as a value creator, manufacturer, or creator of something, right? So that industry germinated as a facilitator between two counterparties. So that was an industry that came about to create trust between two parties that didn't trust each other. And then it has become such a behemoth that that industry is larger than many other industries in the manufacturing sector and several other value-adding industries. So which is a unique characteristic about the Wall Street industry. And also there are probably thousands of intermediaries or players taking part in this who have regulatory licenses supplied by the regulators. The number on record for US alone is 29,000 broker-dealers or intermediaries who are operating as some form of agents or middlemen in the securities industry. Okay, so another characteristic feature of investment banks is that because they are middlemen, they are connecting two parties, they have two masters, right? And they are making money from both parties. So whose loyalties should they abide by? Right? Because let's say you go to an investment bank wanting to do your IPO, and on the other side there are institutional funds like hedge funds or mutual funds or banks or high net worth individuals or rich men like Michael Bloomberg wanting to invest in anything. Then the investment banks are torn between the loyalties of these two because both are their clients, right? So they have to sacrifice the loyalties to one party. So this is why the proverb here, when you have two masters, you have to lie to one. So you can find at any point of time that investment banks are lying to some party or the other. Okay, so now look at this phenomena. Okay, last year was a landmark in the history of economy and money and financial systems that has surpassed the wildest expectations of many traditionalists, you know, not only regulators and governments and central banks and so on, but even the bystanders and observers and watchers by. And what has happened, right? What has happened is ICOs came onto the scene and they have successfully disrupted without ever making any announcements and without making any claims and without making a big hullabaloo. They have successfully disrupted one industry, which is VC industry, because they raised $5.5 billion just in the last 12 months in 2017 alone. So just before this, even in the beginning of 2017, like even by March and April, I was seeing a lot of questions parried around for Ethereum saying, oh, what is your use case, right? And even people like Vitalik were confused and were challenged to come up with real answers. And that is no longer the case because at least we have one use case, which is the token or the ICO, which has definitely made the VCs question about the existence of the venture capital model and question about their relevance in the capital markets going forward. So if you look at where all these players have come from and why there is $5.5 billion of money into the ICOs and who are these people investing, you'll be surprised about some sources, but there is also some traditional money here. So one is the mining pools. So these are the guys who got free cryptocurrencies, obviously after investing electricity and so on for mining, but these were the early adopters of cryptocurrencies, so they got very wealthy. So the guys who started mining really early consolidated their power in Bitcoin and Ethereum, and these are the whales who take a lot of stakes in all the upcoming ICOs. There are lots of seats here in the front. And then you have the exchanges. So if you haven't heard about Binance, which rose to the limelight last year, again, especially after the Chinese ban, Binance founder, Binance CEO became a billionaire, not a millionaire, in a few months' time, because China was going gung-ho about ICOs and cryptocurrencies, and then suddenly in September the Chinese government decided to ban all ICOs, and then where would the Chinese go? So they went to Binance, which was set up just outside of China, but it was by the Chinese entrepreneurs and it was backed by the Chinese venture capitalists. So Binance became an overnight success, helped by regulation, even when regulation has negative intent, right? So all these exchanges played a big part, and folklore goes that today if you have to be listed on any of these exchanges, you have to pay a very hefty fee, like $1 million to each exchange. So here are funds and traders of currencies. These are again some early players who started trading in cryptocurrencies and speculating, and they make daily profits. Of course, this is against the philosophy of hodling, which has come about only recently because a lot of people, at least a majority, are convinced that cryptocurrencies are an ever rising trend. They're not to be speculated on. And then you have the initial coin and token offering investors. These are the real risk takers who actually believe that ICOs hold the future, because for any innovation to come about on top of the basic blockchain infrastructure today, they're looking to these ICO founders and the ICO applications to for Web3 kind of next stack for blockchain. And then you have the traditional financial investors. These are Bain Capital and Andreessen Horowitz. This is traditional money. This is venture capital funds and private equity funds who have taken interest in crypto. So, and then you've also seen some headlines about Bitcoin denominated funds, exchange traded funds and so on. And then there was also some roller coaster about them getting approved, not getting approved and so on. But as and when they get approved, it means a major tick for retail investors from the point of view of regulators, which would make cryptocurrencies mainstream, which would be another inflection point in the journey of, in the evolution of cryptocurrencies and their importance in the economy. So going back again to bashing investment banks, here is the league tables of just the top 10 investment banks last year, and the top 10 investment banks alone made $100 billion of fee income by advising on deals like IPOs, M&A, bonds and so on. These are just initial issuances, and this is not the money they made on lending their capital or lending their balance sheet. This is just the money they made by advising on deals. Okay, are you interested in finding out the difference between traditional investing in a stock or a share and investing in a token? Yes? Okay. So here is traditional investing in stocks, and this is investing in tokens. So here you have founders and outside investors, and there is an operating entity, and outside investors obviously put in money at this operating entity, and entity produces products, right? So founders put in sweat equity and investors have put in real equity, real capital, and their investment lies at this layer, which is the operating entity. Whereas here in tokens, founders of course put in sweat equity and they have an operating layer, but investors, which actually is wrong to call them investors, they are subscribers, they are coming in at a secondary layer, which is at the product level, not at the operating entity level. So they are directly buying into the products, either currently existing products or the products that are expected in the future, right? So these subscribers are coming in with a stake at the product layer and not at the operating entity layer, which was the case when you're investing in traditional equity. However, the difference here is that there is one function which this business model was not serving, which is to create network and platform effects out of products and out of operational entities. So here, because subscribers are coming in directly at the product level, they are directly contributing to building the network effects for the platforms. So, sorry, jump a few. Sorry, jump a few. I'll come back. Yeah. I'll go back to the previous slides. Okay. So if you look at all these platforms, right? So you have Amazon, eBay, Etsy, PayPal, Lending Club, Airbnb, Skype, WhatsApp. These are all platforms, right? These are of course some of the most successful platforms, because if they're not successful, you don't remember them and you haven't heard of them, because out of several competing platforms, there emerged one dominant monopoly kind of a platform which attracted all the users, and that is the one which was successful with its network effects, and that is the one you remember, that is the one you are familiar with, and you have forgotten all others. Because these platforms lend themselves to a model where there can only be one natural monopoly, right? So in earlier traditional world also, there used to exist some industries which naturally lend themselves to this monopolistic reason for existence, right? And those were oil and gas, electricity and stuff. You know, it didn't make sense to have like 10 competitors producing electricity or 10 competitors doing oil and gas and so on, because those were highly capital intensive industries. So similarly, in the modern digital platforms world, there is a certain business model that lends itself to a monopoly, and that's a platform model. Because if there is a Facebook, you don't want to be on 10 different social media platforms, you just prefer being on one because everybody else is there, right? And which is why now with all Facebook's problems, because of its questions on integrity in preserving your data and so on, you know, it is seriously challenged. You know, its business model is struggling today. Because there could be another platform which promises to preserve these kind of things, and then it could go on to become successful. There is one interesting moral aspect you have to think about this, about all these social platforms, which is at the beginning of these platforms. So when the inventors or founders are trying to create these platforms, and they are not yet a network, right? So it is just a software, or it is just an application which is waiting for users. And when they want to try and build network effects, they have to get the whole world onto it. Like not just this room, not just Harvard University, not just Stanford and so on. They had to get, Facebook had to get the whole world onto it, even though it started with Harvard University campus, right? So at that time, they have to lure all parties, you know, whether it is users, whether it is developers of games like Zynga, if you used to remember, and Farmville, was it Farmville? Yeah, these were some very popular apps, right? And you remember them, and suddenly, you know, they are no longer there on Facebook. Those were all value-added things that lured you, attracted you, and retained you on the platform, right? And Facebook at that time had to be loyal and be taking care of all these stakeholders, including users and what provided value to those users, right? So Zynga at some point added value to the users, and so did Farmville and so on. And gradually in its life cycle, after the platform has successfully drawn many users, then the platform starts to think, oh, now I have everybody, and why should I give some profits away to Zynga and whatever, right? And then it starts acting against the very stakeholders or against the very participants that make the platform successful. So in the natural evolution, you see, in the beginning, the platform was naturally loyal to the well-being and the interests of the users, because that's what would make the platform successful. And then once the platform is successful, it becomes anti your interests, because then it is no longer aligned with their interests. And this is the case with all centralized monopolies, right? Then it is no different from any other monopoly, which, let's say, it has a 80% market share, it can get away with charging you whatever prices, and you have no option, right? Which is what Facebook has done now, unfortunately, right? So you've given all your data to Facebook. The troubling thing is Facebook is not even admitting that they compromised with your data. They are saying you've all given your data intentionally and deliberately and they are at no fault, right? So we have ourselves to blame is what they're saying. So this is a natural progression for every platform, not just them, and which is why decentralization can be an alternative to these kind of platforms. Can you go back to the previous slide? Yeah. Okay. So I explained to you the difference between investing in shares and investing in tokens, right? So investing in shares, people were actually participating in the growth of the company by lending them capital, and therefore they had a stake in the company. So if the company did well, they actually owned a percentage of the company, right? So that is why you're all very confident of investing in shares and so on, and a lot of people had questions about why invest in tokens, right? So now I want to make one more distinction between security tokens and security tokens, right? So what are security tokens? So one is, you've seen the phenomena of ICOs last year, and if you have been in the field, playing the field, and if you have been eyeing doing an ICO yourself, you may have heard that with all the regulatory oversight coming in, there's some seats here in the front. With all the regulatory oversight coming in, you want to stay clear of the supervisory side of the regulators, and you want to make it a utility token, right? So you may have heard of this. So while you are trying to create a utility token, but you slipped up somewhere and you ended up with a security token in an ICO, that's a different kind of a security token. That is this security token, which is what the regulators have as a tool in their hands to say, hey, your ICO is a security token and we are going to punish you because you flouted securities laws. And that security token is an accidental outcome or sometimes an intentional outcome when someone is trying to create an ICO. DAO, for example, you've all heard of DAO, right? Ethereum DAO. Who hasn't heard of DAO? Do you know what is DAO?
Dow Chemical?
No, DAO. No. Okay. You've not heard of DAO?
Ethereum failure. Yeah.
Okay. So DAO was an investment fund, okay, which was set up in 2016, I believe. It was a $150 million investment fund, and it was a decentralized autonomous organization. It was like a software entity which would be algorithmically run. So it was a fund which was contributed to by some of the blockchain founders, and it would be run algorithmically, and there would be proposals of people who wanted investments, and voting would be taken on the fund, and the fund would disperse the funds to the proposals they voted on. But all this would happen without the presence of a general partner or a venture capitalist or a private equity manager or a fund manager. This would happen just by a software because it has been designed, it has been coded to run on its own by algorithms. Okay, so DAO, which stands for Decentralized Autonomous Organization, was the first ever fund which closely imitated or resembled a security, because a venture capital or any variants of it is a security, right? Because it's dealing with money matters. So that was a security. But there were also other securities which were accidental. Like for example, people said we are doing an ICO, but we will give dividends for these tokens, because at that time nobody was thinking about this distinction so clearly. And those were security tokens that came out from the ICOs. And now, when I talk about security tokens, which is security tokens, let's say 2.0, what I mean is companies in broad industries like manufacturing or pharmaceuticals or R&D or robotics or these kind of companies which have nothing to do with blockchain, so they don't know, but they want to issue crypto form of shares. So, so the characteristics of what they are issuing would be that of a security. By security, I mean a share and a bond, not cyber security, right? So there are too many different definitions of security floating around here. So if a traditional company which does not have a token, which does not understand blockchain and does not need to understand blockchain, wants to issue a security which is a share or a bond by using a blockchain platform or in a crypto form, that is also a security token. Do you now understand the difference between what I was explaining earlier and what I am explaining now? Yes? Okay. So what I was explaining earlier, the security tokens that were constrained to the domain of ICOs, only a few people can do, right? At least as of now, right? Because they have to understand blockchain and they have to be familiar with ICOs and the whole process and so on. Whereas the security tokens, which I explained here, anybody can do, provided there is a platform which is taking care of the compliance and so on, right? But if you are able to provide such a platform to issue these kind of security tokens, and you give access to all sorts of industries and all geographies, then imagine you are giving a blockchain enabled tool to the whole economy, to the whole world, really, right? So there would be a blockchain tool in the hands of people to raise money as easily as somebody is raising an ICO. So that's the potential a blockchain application can have when I say you can take blockchain truly mainstream, right? And these are some of the industries that have still not been touched by blockchain and decentralization. Okay, let's skip this. Okay. So how can we do this? How can we achieve this vision, right? So this comes about from the invention of smart contracts, and Nick Szabo was the pioneer of smart contracts, and he's been working on smart contracts for the past 40-50 years. He's a very renowned computer scientist and cryptographer who came up with this concept called smart contracts, where smart contracts could be coded or programmed into a computer to carry out business transactions or business logic between two or more multiple counterparties without the intervention, without the human intervention of both these parties. So if you code a logic saying if X then Y, then the smart contract will always execute that without any interference. So there are four characteristics of smart contracts, which is privacy, observability, enforceability, and verifiability, right? So if you look at Ethereum, and if you really go deep into what Ethereum is the world's first ever platform created to code these smart contracts, right? And what are some of the examples of smart contracts? So a smart contract would be something like a vending machine, right? So if you go and see some products in the vending machine and you put some coins, you will always get the product. Of course, there will be times when it is faulty and you get your coins stuck there, but you can always expect the product to come out once you have put in the money. So that's a kind of a smart contract where there is no one sitting at the till and no one examining, and the computer code inside the vending machine does the function of a smart contract. So a smart contract is a contract defining any business logic or any contract, any business understanding between two parties whose performance can be verified by a computer, regardless of human participation. So if you extend this concept of a smart contract also to the financial world, to the securities world, to financial services and capital markets, then what does this mean? So right now, if you imagine or envision a smart contract as payment, okay, it's very simple concept, okay, payment to be distributed between two parties, like between you and between you, saying if the lecture goes well, you will pay him £100, and if the lecture goes badly, you will pay him back, and both of you have put in, let's say, £50, right, to the pool. So right now this is the simplest smart contract where a payment is involved between two parties, and there is a very simple logic, right? There is only one question which determines the logic. Is the lecture good or bad? Right? So that is the simplest kind of smart contract you can have. Now if you look at a complex smart contract, which is, let's say, a bond or a share or like a mortgage or you know, more sophisticated derivatives and so on, they have multiple cash flows, and those cash flows are released at multiple intervals, right? And there is not one logic, there are many trigger points, and cash flows are spread over the maturity of the instrument, whether it is the bond maturity or if it is equity, then you have to give them dividends, and then the final capital appreciation and so on, right? So financial instruments are more complex, so if you have to make them amenable to smart contracts, then the smart contract functionality has to be more sophisticated, more complicated than the simplest kind of smart contract. And if the simplest kind of smart contract is only dealing with payment, then it can be done with Bitcoin. So we have had a lot of players in the past year which have come about for the purpose of doing the business of doing solely foreign remittances, right? So foreign remittance from US to India, foreign remittance from UK to the Philippines, or take any immigrant rich country like Bangladesh or Africa or whatever. Then you have foreign remittances which are done with Bitcoin, bypassing the correspondent banks and so on. And that was the very simplest use case of Bitcoin. Forget about blockchain and so on, which came later, right? So that is the very preliminary basic kind of smart contract that you can envision, where you are just sending a payment by Bitcoin, and there the recipient converts that Bitcoin into their respective country's fiat. And that's a very simplest kind of a thing. But if you also want to use cryptocurrencies for myriad functions, for example, I'm going to talk later about how to create a stable coin or a pegged coin using cryptocurrencies. You know, these are more sophisticated concepts, and the more evolved this landscape becomes, then the more you can penetrate into the real economy or to the real financial services world, right? You can even imitate the function of a central bank completely using distributed ledger technologies and decentralized world and cryptocurrencies. Okay, so the point of this slide is that yes, you can imitate or mimic the functions of real financial securities with smart contracts, but of course those smart contracts are more complicated, more sophisticated than the ones we are dealing with right now. Okay. So this is an ideological problem we have today in the world, where you know that the capital flows are not very smooth all over the world, and there are several reasons for this, because different countries have different tax regimes and different growth rates, different access to capital, different credit economies. Like some countries have very easy access to credit, some other countries have a lot of need for credit but no access to credit and so on. So even though growth rates may be very high in some countries, they might not be having the same kind of access to capital, right? So in a perfect world, the capital should flow to the countries that are growing the fastest, like emerging countries and so on. But it doesn't happen in the real world because of all these heterogeneous reasons. So if you were to create one global borderless capital flow or a mechanism to facilitate that, then a lot of these chinks would be ironed out. Next. Okay, so go back to one more. Yeah, okay. So one problem we have is almost every company in the world raises capital at some point or the other in their life cycle, right? So even Facebook, which is the most successful today, what did Mark Zuckerberg do before he married? He was it before he married or after he married? He took the company public, right? So taking the company public is a milestone in the journey of an entrepreneur, right? So every entrepreneur has to raise capital. So if you don't raise capital, then you shouldn't be calling yourself an entrepreneur. You should be calling probably yourself an enterprising student, right? So every entrepreneur has this destination or goal of getting himself listed somewhere, of going public at some point of time, right? And that process is very complicated and it involves a lot of intermediaries and it is expensive because look at this case of Saudi Aramco, the IPO of the Arab Oil Company, which is the biggest IPO ever in the history, and it would have been $1 trillion or whatever. And imagine if that IPO were going ahead, how many banks would make what kind of fees? Because the investment banks charge 7 to 10% of the fees of the proceeds that you raise through an IPO, which is very expensive. Okay, and then to protect the participants in these markets, which are investors, you have a lot of laws that have come in over several decades and probably centuries, and those laws are good, right? So those laws protect the investors like us all from being cheated, from being taken advantage of. For instance, not only in the company's case, you've also heard of the recent headline, which is Theranos, right? Theranos, the blood test company. There was a female entrepreneur who was very famous in Silicon Valley, and SEC has gone after her now, saying she has done fraud. Okay, so that is an outcome or a fallout of a securities law. If it was not for the securities law, anyone would be free to raise whatever amount of money and for whatever purpose. So let's say somebody said, I just want to have a fun vacation all my life and I want to raise $100 million, and people actually invest in them, then there is no problem. But it is not possible because of the securities law, right? Because regulation has evolved to protect investors from being taken a write-off. So Theranos is the perfect example. Even Facebook, which is facing all sorts of scrutiny now, saying, did Mark Zuckerberg sell his shares recently after this news? Was it insider trading and so on? All these are questions that are coming up because of securities law. If it was not for the law, then nobody needs to be under any scrutiny. People can do what they like, which is in their best interest. Of course, they are always acting in their best interest. Is it in the best interest also of the investors? That's the question that the securities laws ask, right? So securities laws are not bad, they're good, and they're here to protect you. So some of the good things they do. So in the instance of exchanges, for example, like let's say NASDAQ or London Stock Exchange, these regulations protect you specifically from exchanges acting against your interests. Because these are centralized intermediaries, a lot of processes are happening secretly, behind the firewalls, right? You can never see what those processes are because they are not transparent. So, but for the securities law and the regulation, you can never be sure. And even with the threat of this law, you cannot be sure because they only get caught when they're caught cheating by the investigator, right? So, there are still centralized intermediaries where a lot of processes are opaque. You're not an investigator, and even if you're an investigator, nobody is going to give you permission. So let's say you're an investor and you suspect something, and you go and say, London Stock Exchange, I would like to take a sneak peek at something. They say, excuse me, who are you, please go away. Right? So these processes are not only opaque, nobody has the right to see them. So unless something is unearthed, like a fraud or a scam, the question of protection does not even arise. And if you look at common law precedents, right, the law which is the police and the going to jail and those kind of threats, what is the premise of that common law? Premise is that usually you don't get caught cheating, so when you do get caught cheating, you have to be meted out disproportionate punishment, because then that is a deterrent for future conspirators or future criminals, right? So that is the premise of the common law. But if you turn this premise on its head, and if you make something which is verifiable, right, which is, if you replace the opacity of these processes with something that is transparent, not transparent in terms of details, but transparent to the scrutiny of public and verifiable. The security and performance of it is verifiable by computer science, not by people, because people can always be mistrusted, right? So these centralized organizations today, yesterday, Mark Zuckerberg was a hero, and tomorrow he could be an anti-hero, because the tide could turn against him, and all of us could say Mark Zuckerberg has played with our data security, and suddenly he is no longer a hero, right? So wherever there's humans involved, the consistency there is no consistency in both our perception and also their behavior, right? Whereas computers, there is no question of a code going rogue and suddenly becoming anti-hero, right? Like the code is there to do whatever you have told it to do. So that's the thing of blockchain, where you have coded something and you can rely on the code's consistency to securely, to provably verify security. This was a major breakthrough, right, in the history of business systems, and we are still on the cusp of grasping the profoundness of this invention, which is being able to substitute a bunch of army of legislators, of regulators, of banking institutions, lawyers, executives, and so on, and replacing that with a bunch of computers whose computational power may be a bit expensive. It is not cheap, but it is solid, it is consistent, it is predictable, and it is verifiable, and it's transparent. Always. There are no exceptions. Okay. Another look at the crowdedness of the capital market space, right? So not only do these securities laws tell you that you have to be regulated, you have to have certain licenses before you can deal with somebody else's money, or before you can act as an intermediary between people who have money and the people who want that money, right? You need to have certain licenses. So despite that entry barrier which has been artificially imposed to protect the investors and through securities laws, this is the number of categories of players we have in this, which is just befuddling. Okay, so again I have delineated here what are some of the good functions that these intermediaries perform, and what are some of the things we can get rid of in these intermediaries. So on the right side, the good reasons for which they came into existence and became successful is there was asymmetric information between the two counterparties, between those who wanted money and those who had money, right? Asymmetric information. Whereas if a Goldman Sachs came in the middle and said, hey, we vouch for the authenticity of this information, and this investment memorandum has been produced by us, they are giving a stamp saying there is no information asymmetry and this information can be trusted and relied upon. And then there is complexity of relationships between laws and regulation, right? So if you look at securities laws, they're different across different jurisdictions, and you need nothing less than multiple specialists to actually just understand these laws and translate it to you. Same is the case even for ICOs law, unfortunately, where we have to employ equally expensive lawyers to understand each jurisdiction's regulation and to translate it in a language that we understand. So that was the function that these investment banks were performing. And then they were also building a price tension between two parties. So let's say somebody is really desperately in need of money and he has a house to sell. He really doesn't know what is the market value, or he couldn't care. Like let's say if he waited and was more patient to go and seek better buyers for his house, but he couldn't care because he's really desperate. So he can act against his own interests by being desperate, whereas an intermediary can come in and say, hey, you stay out of the picture and I'm going to pose that you're not desperate and I'm going to find a better price for you, right? So that was another role, another valuable role that the intermediary or the middleman. Social scalability of internet. The first thing was price discovery and the second thing was matchmaking, right? So internet already solved this problem of asymmetric information. So the first function of intermediaries is gone because internet can do much better than a Goldman Sachs can do in terms of doing information match. Second, complexity of relationships. You still need to understand, so that is still an element of value that the intermediaries can provide in simplifying the understanding of law and translating it to you. But it does not need to be a Goldman Sachs, right? So you can give this job to anybody who can decipher the law and regulation, and of course you don't have to pay 10% of capital proceeds for you to for somebody to help you understand these kind of laws. Like somebody would be happy to do that even for a few £1,000, let's say, right? So here is another role that is gone or rendered redundant. And third, price tension built, right? So the assumption of the role of intermediaries in building price tension is that you cannot build the price tension yourself in your buyers, right? So which is also gone by a lot of, which is demonstrated by a lot of platforms where you have a lot of e-commerce with very high value items like art and houses and stuff, which are being sold very well, and it is established that you don't need the presence of intermediaries. Of course, it's a little bit complex if you want me to argue logically about how it is relevant in investment banking, but all of these roles no longer require intermediaries to play at least the traditional roles that they have been playing. And this has come about because of the technological advancements, because of the internet, and now suddenly this new profound invention which removes the need for intermediaries even for exchange of value, right? So internet already proved that even for big value e-commerce items you don't need intermediaries, and then now blockchain with trust minimization of exchange of highly valuable things without somebody else needing to guarantee, you have completely removed the need for intermediaries. So this whole blockchain movement is founded upon the principle that trusted third parties are security holds. So if you listen to any talk of Nick Szabo, this is the primary foundation from which all decentralization principles and they're explained. If you can't see these things, these are all hacks that have happened in the Bitcoin and cryptocurrency world in the past decade, right? Which is ironical, right? So this is Mt. Gox, this is Bitfinex, this is Cryptc. I can't read some of them myself. But in the recent past, you've even had a $500 million hack on an exchange called CoinCheck, right? So take a moment, pause for a moment to think. We are in a decentralized world now, and we are looking at these hacks, $500 million, right? CoinCheck lost $500 million in one hack, and Parity lost some $80 million in one hack. Mt. Gox lost like $400 million. That was a few years ago, and several $billion lost in the cryptocurrency world, which is founded upon decentralization. So what is the missing thing here? Did I explain what I am trying to ask?
Yeah.
Okay. So we are in a decentralized world where we are saying we don't need intermediaries to trust each other, and we've lost all this money. Not me, but several people, several other sad people have lost all this money, right? Because they have all been lost to centralized intermediaries again in the cryptocurrency world. Because all these exchanges which lost the money, they were again replicas of the real world which we set out to replace. They were all centralized intermediaries, right? Who you were trusting to hold your private keys, to hold your assets, and so on, right? So we are still bringing aspects of the centralized world here. And they proved themselves again to be security holes. So that's the point Nick Szabo is making. The trusted third parties are security holes. Even if they are cryptocurrency exchanges, they are still trusted third parties. So where does that lead us, right? So in a decentralized world, if something has to be completely trustless or trust minimized, everything has to be decentralized, including these exchanges, right? Which is why 2018 is going to be a landmark year, because 2017 was all about centralized exchanges which raised these $5.5 billion on these ICOs, right? So if ICOs raised $5.5 billion, they all raised on some platform or the other, and predominantly those platforms happen to be centralized exchanges, right? So if we have to move forward as an industry, or if people are getting any smarter, then they would be naturally leaning towards decentralized marketplaces, decentralized exchanges, which are a step further from the centralized exchanges, and of course a damn threatening lot for the gatekeepers, which is the securities guys, the regulators, central banks, and so on. Okay, so now let's look at the stock exchanges, right? So now I'm talking about the real stock exchanges like NASDAQ, like London Stock Exchange, Bombay Stock Exchange, Tokyo Stock Exchange, and so on. So here I have listed the market capitalization requirements, and here the fees, listing fees, right? So in the whole world there are like hundreds of exchanges, and these exchanges control a lot of money. So just NASDAQ alone supposedly controls 4,100 companies, which among them had the market capitalization of several $1 trillion, okay? And exchanges themselves are a concentrated form of power, because a lot of capital formation is happening on those exchanges. And recently there was an attempt by NASDAQ to buy out London Stock Exchange. And if there was some consolidation of this manner going on between geographies, then this concentrated centralization could pose a lot of threat to, to all the things that we have talked about earlier. Okay, because see here, Dubai, for example, is saying you need to have a market cap of $50 million, because that's NASDAQ Dubai. Let's take some other exchange. It is saying $200 million. Something else is saying much less. London Stock Exchange is saying $1.2 million, right? So if you have a company in Dubai or Tokyo or New York, and if you want to raise money on that geographical exchange, the minimum threshold that you need to have before you can do an IPO is vastly different, right? And same thing for the fees as well. This is not necessarily bad or wrong, but this just reflects the power that the exchanges have, because they are kind of monopolies, right? And in some countries, actually there is no alternative. There is only one single exchange operational, and that is run by the government, and there is no alternative. So what does it mean? It's a pure monopoly, right? So you have no option other than to take whatever that exchange is giving you, and you have no flexibility to question their performance and so on. So bringing you to this concept of how to create an alternative for these centralized exchanges. So is it possible? Is it possible to take power in your own hands and issue your own securities and get rid of these exchanges? What do you think of this thought?
Good idea.
Regulation.
Sorry?
Good idea.
Good idea. Okay, great. Okay, so is there a rational reason for doing this? What can this do to people around the world who want to be entrepreneurial, who have talent, right, who cannot access capital. Maybe they didn't go to Ivy League school, maybe they're not based in Silicon Valley, or they're not friends with VCs and stuff.
Create opportunities.
Yeah, it's extremely empowering.
Yeah, enabling.
Yeah.
Okay.
That's
So-
inclusion.
Microfinance.
So, if you look at Alibaba, right, Alibaba is a giant success. And Alibaba is a giant success not because they had genius products or genius platform that, you know, there was nothing else like it in the world, but it was successful because it was the first platform to empower Chinese small businesses, right? So it gave Chinese businesses the power to sell their products to anybody, and nobody else did that before. It was Jack Ma who came up with this, saying, I want to empower small and medium businesses, and no one is taking their side. They need a lot of working capital, they need loans, they need capital. Banks are refusing to give them capital because banks and everybody with money only want to give money to those who don't need it. And nobody is giving money to those who need it. Is that a truth or no?
Yeah.
Right? So look at blockchain industry. Now you may envy the blockchain industry for having raised, a lot of people have become millionaires last year, okay? So somebody who used to be your friends may no longer be your friend because they're sitting on $100 million stash. But it was not always the case. At least the blockchain companies that started 5-6 years ago, they struggled because no one was investing in them. No VCs, no products, no clients, right? So there was no revenue, they were struggling. Right? They had to give these workshops and seminars and hope that, you know, they're doing something productive. So basically the blockchain industry was struggling for many years before these ICOs came along, and then the scale tilted suddenly, you know, the other way, and everybody became millionaires. Everyone now has more money than they need for the next 10 years. So when the capital markets are not serving the entrepreneurs that need money, why not take the power in our own hands to reach the investors and to convince the investors directly and to decide to issue securities at our own rules, manage the communication process with the investors, and basically take back the control. Because now you have a mechanism wherein you don't need a middleman to guarantee or to ensure that you are giving value in exchange for value, right? There's blockchain to do that.
So what's the main difference between this model and the crowdfunding platform? Because that's also a platform enable a lot of small business to sell their product or sell the equity.
So the crowdfunding platform still requires a centralized player who is between you and the investors.
Well, I thought that's the help there for preventing scam, right? So if it's a completely
Well,
decentralized.
so the regulators are doing the same thing. All these exchanges are also saying the same thing. They are all preventing scams, right? Everybody is preventing scams. But you don't need like millions of people preventing scams. Probably you need like one US government or whatever. I don't trust US government. So the whole Bitcoin has come about because it doesn't trust or it doesn't need to trust US government or any government, right? So you don't need billions of people preventing you from scams when you can prevent from scams yourself. Well, if you can hold on to the questions, let me just finish because there's a lot more.
15 minutes.
So that's the concept, right, of giving the power back to the companies, of issuing securities as they want, to whom they want, and how they want it, and to service them as well. So here is a quote, which is lengthy, but I'll read it out for you. When we can secure the most important functionality of a financial network by computer science rather than by the traditional accountants, regulators, investigators, police, and lawyers, we go from a system that is manual, local, and of inconsistent security to one that is automated, global, and much more secure. Cryptocurrencies, when implemented properly on public blockchains, highlight public blockchains, can substitute an army of computers for a large number of traditional banking bureaucrats. these blockchain computers will allow us to put the most crucial parts of our online protocols on a far more reliable and secure footing and make possible fiduciary interactions that we previously dared not to do on a global network. So blockchain dares you to do billion-dollar deals on computers and not via investment banks. This is a quote by Nick Szabo, by the way. So we want to create the world's first public equity issuance platform, and for the initial issuance, there's a lot of other players who want to tokenize existing securities, like existing assets, existing shares, existing homes, existing gold, and so on. We're not talking about existing securities. We want to create an initial public offering platform where companies can go and raise money for the first time, not by issuing tokens, but by issuing shares in the crypto form. Okay, now please, let's skip. Okay. How are we doing on time?
So we got 15.
Okay. Here is a pictorial depiction of how this may happen. So on one side you have issuers. Issuers is anybody who wants to issue securities. That's all of you. If you want to raise money, you have to issue something in return for money, right? And that issuance is called a share or a bond, which is a promise to return back something. So if you're profitable tomorrow, to return back profits in the form of dividends. Or if you have borrowed a loan, to return back the principal and some interest, right? So you promise to give back something in return for the money, and that something is called issuing a security. And it is called a security because it is dealing with money. It's not the cyber security, right? So on one side you have issuers, and this may be any form of issuers. This may be corporates, this may be governments, this may be educational institutions, this may be even individuals who can issue securities. On the other side, you have investors with any form of funds, which can be students like you, or could be rich people like Bill Gates and Michael Bloomberg, and it could be hedge funds or the crypto funds that you saw earlier. Anybody with money, whether it is institutions or individuals, and they can have a smart contract where the issuer has a smart contract, just like it is happening in ICO now. ICO is nothing but a smart contract where you send them money and the ICO issuer sends you a token, right? You don't need to call the ICO issuer saying, hey, I'm sending you money, send me these many tokens. You just send the money to the smart contract, and smart contract automatically issues you tokens. Similar principle here. The smart contract automatically issues you a security or a token that represents a real security, represents a real share or a bond. And the issuer can define what that security represents. Whether it is 1/100% of the company, or whether it is 1/10,000% of the home, or whatever it is for the issuer to define. And smart contracts can, without fail, right, with 100% reliability, can exchange the security for the value. So this is an exchange. This is a modern exchange enabled by blockchain that is a substitute for all the exchanges we saw earlier, all the NASDAQs and LSEs. And not only have you created a substitute exchange, but you have also done one more profound thing. You have removed the investment banks from the picture. Because earlier, to go to an exchange, you needed to mandate an investment bank like Goldman Sachs and pay them 10% fees. If you can exchange your own securities now and can receive capital directly from your investors, not only do you not need the investment bank, but you have also saved that 10% money. Okay, here is another profound thing. For all these things to happen, like for cryptocurrencies to really permeate the real industry and the real economy, there's still some tools which are yet to come about. So one of them is a stable coin. So right now, if you were to implement the model that I just explained to you, right? If people have Bitcoin and Ethereum, it's okay. They can send you Bitcoin and Ethereum and you can send them securities. And you don't need the intervention of anything else. And you don't need banks, you don't need exchanges, right? But if people want to send you US dollar or Indian rupee or Malaysian baht and they want to get your securities, then there's a problem. Because you have to take permission from those governments who can say, hey, cryptocurrency exchanges are banned from tomorrow, right? So how do you deal with that problem? So one of the solutions is this stable or pegged coin, which looks very simple. So let's say you have a dollar peg token, right? So Tether used to be that, for example, which is a major disaster now. But the dollar peg token, which looks very simple, it is a cryptocurrency that stands for the exact equivalent of $1. And the simplest thing to do would be you keep $1 in your bank account and you issue a token that represents $1. And if the token value goes down or something, there is the $1 in the bank which is supporting it. Simple concept. But even there, Tether failed because that also proved to be a centralized thing where they were not actually keeping the $1 in the bank, but they were issuing a Tether pegged dollar, right? So even simple concepts like these are very complicated to manage because you have to look at centralization, decentralization, and so on. So there are various ways to create the stable dollar or pegged dollar. One of them is centralized IOU issuance, which is what I just illustrated by way of Tether. Second is collateral backed. So if you were to try to accomplish this using only cryptocurrencies, let's say you want to create a $1 peg token and you want to create this with Bitcoin and Ether. Today you can put Bitcoin and Ether equivalent to $1, but tomorrow, let's say Bitcoin price crashes by 50%. Then again the peg does not hold. So you have to over collateralize, right? And in an asset class which is so hyper volatile, how much can you over collateralize? 10 times, 100 times, 2 times, 1.5 times? You never know, right? Because the peg can still fail. So people are now writing protocols to come up with cryptocurrency backed collaterals which will still hold a stable value. And these are all complicated things to achieve, right? So we are seeing all these kind of advancements. That's the second one. And the third is seigniorage shares. So actually, seigniorage, do you know what the term seigniorage stands for? It's the term for what central banks do. It's the issuance of currency. Okay, so central banks issue currency and they issue currency in response to the perceived demand and supply of currency, right? So if they want to boost economy, they have these tools like inflation and control the supply and so on. So here is a method, here is a proposed method to achieve the role of central banks in a decentralized way. So earlier I explained to you how DAO tries to substitute for a VC firm's function. So here a DAO tries to substitute for the function of a central bank. So this is the seigniorage shares, where you can attempt to create a central bank's function just by algorithms and code. So this is the power of smart contracts. So you can create a central bank. Of course, the central banks are trying to create a centralized cryptocurrency, and the cryptocurrencies are trying to create a decentralized central bank, right? So the future is going to be really exciting. So what can we do? So if we have this stable coin, there are many ways to achieve this, and we have investors and issuers on both sides. Not only can you issue the initial public issuance of securities, but you can also service them, right? Once you have issued securities on the blockchain, you have the contact database, so whenever you need to distribute dividends, you don't need to send a check in the envelope. Right? You can, the same smart contract which gave them the security can also send them dividends, right? And can also take back the dividends if they want to reinvest it or whatever they want to do, or if they want to transfer the dividend to their son, while keeping the shares themselves. It can do whatever, right? So not only the servicing of securities, but also the governance structure. So what do the shareholders do? Shareholders are the real owners of the company. Even though you're holding just a piece of share, you are the owner. So every time there is an annual general meeting, all the owners are called upon to make decisions for the company, right? This is done through votes. Of course, in practice, in reality, all these shareholders never go to AGMs, so the owners are in absentia. But if it were to be done on a blockchain, I'm sure, at least, if not 100%, at least 30% or 40% people will send their votes and say, hey, Mark Zuckerberg, I like what he's doing, man. It's my data, I did whatever I liked with it. Or saying, hey, I didn't want Mark to do this, and this is not what he should be doing. So these kind of decisions, the shareholders have the power to decide on, and these are actually taken at AGMs, right? Then we would not have these conflicts of interest and morality problems, moral hazards, right? Agency problems. These kind of things would disappear. So it's a governance tool, right? Suddenly we have the power of a blockchain, which is taking the inputs from the owners into decision making of the governance. Okay. So all these things are revolutionary, which have not been tried, which are possible for the first time with blockchain. Okay, please skip a lot of them. Skip. Okay. Go back to the slide. Okay. This is an important slide. This gives you a snapshot of where we are today with cryptocurrencies. So you had trust minimization of cash first in the form of Bitcoin, and then you had trust minimization of contracts, which are business agreements, which is computing, Ethereum. So these are the two landmark things. And then the landmark ICOs came, where there were 1,000 ICOs which raised a lot of money. So you all empowered these ICOs to go and innovate and to disrupt real existing industries. So you trusted these ICO founders to actually come up with innovations that go and do something transformational in real industries. So you've just invested in them. So the future could be very promising, right? So these ICOs could go on to disrupt many industries. So these are tokens. While we struggled a lot with the regulators and a lot of seesaw about how to view these cryptocurrencies and so on, the next stage is security tokens. When blockchain permeates the real world, people who don't know about tokens and who don't have to know, they just use a blockchain platform to raise capital by giving all sorts of financial instruments. So they can create any custom financial instrument using a blockchain and make it a security token. And if blockchain or cryptocurrencies can be used as a platform to issue these security tokens, that is a real big next $1 trillion thing. Okay, so we haven't even seen how it looks, because all these ICOs, I skipped a lot of slides which would have shown you, all these ICOs are targeting tiny industries which have some minute application somewhere, but this is really the big deal where you can transform the entire capital markets. Okay, so here is some comparison between centralized and decentralized for those who are technically well versed. And this is a slide that tells you about the current constraints of blockchain technology, right? So here are the successes, these are the winners of the current era from the traditional centralized institutions, right? Visa has like 50,000 per second kind of transactions, no one can beat it, and so does NASDAQ. And PayPal a little bit less, but when it comes to Bitcoin, it really diminishes. So we are the worst in performance, and that is necessarily so because by definition, decentralized or distributed technologies work on duplication and not on efficiency and performance, right? And this is by definition. And whenever you have to move down this curve towards better performance, it has to be at the expense of security. We're very close to ending, so it has to be at the expense of security. So there is a trade-off between performance and security, and this applies to everything, including distributed technology, and that is a big
Don't exist right now.
platforms.
On top of platforms don't exist right now. So you talked about you needing stable coin.
Can you just
We haven't seen those.
speak a bit louder?
You're talking about building platforms or protocols on top of things that haven't been proven to work right yet. So stablecoin is not one of those that works currently.
Okay, okay, we'll leave that to questions because I didn't hear properly also. Okay. Here is a news article from Asia Sentinel which called us the Uber of investment banking. And another thought is that I showed you a lot of platforms, but the real big behemoth platforms like Alibaba, like Amazon, like Uber are the platforms that married the digital world and the physical world, right? Facebook is a platform, but it's a completely digital platform, right? But Amazon, on the other hand, is a physical plus digital platform because it's supplying you physical goods on a digital platform. Same thing with Alibaba. Same thing with Uber, right? Uber is really big because it's connecting you with physical cars and physical drivers in a digital way. So the things that connect you with physical things in a digital way are really big and much bigger than the things that only connect you digitally, even if it is Twitter, Facebook, whatever, right? So that's a thought I'll leave you with. Okay. So blockchain finally put this power in our hands to take on these really powerful forces like Wall Street, and that's really thanks to smart contracts and blockchain that even small, tiny startups like us have the power and the vision to go after, to re-architect the whole landscape and to disintermediate very big industries like capital markets. Okay, so I went on a global tour for the past 6-7 months, and these are all pictures from everywhere. Okay. Okay. I wanted to talk to you about a lot more stuff, but this is all the time would allow. I'll leave you with one thought, which is Bitcoin first enabled you to do unstoppable cash, right? So even after several countries have come and said we want to ban and we treat this illegal, we treat this as a fraud, Bitcoin is truly unstoppable or not? Okay. And then we came to unstoppable computing, Ethereum, right? You can create a smart contract for any damn thing on earth, not to marry or to pay somebody, to gamble, to do illegal, to do legal stuff. You can have a smart contract for anything because it's peer-to-peer, and there is a platform where you can code any logic and it will execute, right? So as long as you pay the gas to the platform that's coding the smart contract, you have something for unstoppable computing. That was Ethereum. And when you do that for unstoppable capital, I won't ask you what is going to happen. I want you to go back and think what can happen to the world when you make capital unstoppable. And that's my mission. Thank you.
Thank you.
Okay, now you can ask me questions.
Sorry, the room was booked at 7:30.
Okay?
Yeah, so we'll have to.
We'll have to leave?
Yeah.
Like right now?
Yeah.
Okay.
So guys, thank you so much for coming. Thanks again to Arifa for